Hi everybody, it's Frank Verney again, and I hope you're having a good day. I want to welcome you to another edition of Real Estate Help by Frank. You know, as the economy continues to sputter along, we're confronted by mixed signals as to whether we're actually recovering. Real estate prices are starting to go up, foreclosures are slowing down, but unemployment continues at fairly high levels. Today I'd like to take a few minutes and update you on what our Federal Reserve just did on September 13th to attempt to stimulate our recovery and the housing market, and what these actions may mean for you. The Fed settled on an aggressive bond buying campaign called Quantitative Easing, aimed specifically at boosting the housing market and consumer attitudes. This is the third time the Fed has done something like this. Faced with slow growth and increases in long-term unemployment, the Fed agreed to buy mortgage securities. The purchases of $40 billion a month will be open-ended, meaning that they will continue until they're satisfied that economic conditions, primarily again in unemployment, do improve. The Fed also lengthened its commitment to keep overall interest rates at close to 0%. It promised to do so through mid-2015, more than halfway through the next presidential term. Now, quantitative easing is basically the printing of money, which the federal government, of course, has the right to do. It then uses this new money to buy bonds from big banks. In effect, it gives them cheap loans, which in theory will enable them to drive down interest rates, allowing further business expansion. The step is designed to further lower already historically low interest rates and make home buying more affordable. Based on this, we should see mortgage rates decline to new record lows over the next few weeks. So far, everything that has been tried to jumpstart the economy and create substantial job growth has not worked. Quantitative easing is an emergency policy that, arguably, is only put in place when everything else has been tried. These actions are a temporary stopgap measure used to artificially strengthen the economy until it gets start moving again. Many analysts are concerned with the long-term impact of this program because by printing money, they devalue the dollar, and with that, they are increasing the supply of it. When the value of money is devalued, it creates a situation where all products will eventually cost more, and this starts the inflation cycle. So it's very important that the Fed stays on top of their actions. One thing, however, is certain. No one knows for sure what lies ahead for our economy, but this upcoming presidential election should shed some light on two distinct views of where we're going and how we should get there. So, stay tuned. But, for the meantime, mortgage interest rates will continue historically low, so it's a great time to buy or refinance. Now, if you found this useful, please forward or share it with anyone you know that could benefit from the information. I'd also appreciate any comments below, and by all means, please subscribe on the right to receive further updates. Feel free to contact me if you should use my help or have any additional questions. I'll see you again soon. Thanks, and good luck.